Right. Good morning, everybody. Good morning and happy Thursday, all you magnificent melon heads of the world. Today is December 19th, 2024. And guys, yesterday was a bloodbath, courtesy of our good friends at the Federal Reserve. Yesterday can only be described as a hawkish cut. A hawkish cut. You might be saying to yourself, Jack, what in the ever-loving jumbo shrimp is a hawkish cut? Well, yesterday was a hawkish cut. The Fed cut interest rates by 25 basis points. Largely expected. Or nobody was surprised at all by that interest rate cut. That is not why the market tanked yesterday. The market tanked yesterday because of the changes in the dot plot, or the summary of economic projections, sometimes called the SEP. Because besides the rate cut yesterday, there was two very big changes to the Fed's projections of what next year is going to look like. All right, first things first, the Fed revised their year-end 2025 projections for inflation upward from 2.1% to 2.5%. So right away, we got some contradictory information going on here, right? The Fed just cut rates, but their inflation projections are moving higher. Lucy, you got some explaining to do. Why are you going to do that, Jay? Why are you cutting rates if you're telling us inflation is heading higher? I thought you had a 2% target. But wait, there's more. It gets even better. Because besides that increase in the year-end inflation projection for next year, the Fed also has two rate cuts factored into the end of next year. Now, that is two rate cuts. It was last month, it was 4 rate cuts were factored in by the end of next year. So they lowered their projected cuts from 4 to 2 while raising their inflation projections and simultaneously cutting interest rates. Now, guys, depending on which side of the Fed's dual mandate your priorities lie, there's something in there for everybody to hate on, because what happened yesterday really made no freaking sense whatsoever. How are you cutting rates if inflation is moving higher? And at the same time, how are you projecting additional rate cuts if inflation is moving higher? This doesn't make sense. Well, it does make perfect sense if you factor in that Jerome Powell is cornered now. And we kind of alluded to a little bit of this during the question and answer segment yesterday with the Fed press conference. And by the way, all of you sycophants in the Fed press pool over there, you know, Steve Leishman and co., welcome back to journalism. Instead of just endlessly cheerleading, cut my rates, bro. Why not just cut 50 right now and help out Communa, right? Actually asking probing questions of the Fed, actually getting to the root of the matter. It's almost like something changed November 5th, and all of a sudden they're willing to speak truth to power again. Isn't that just amazing? But look, there was a lot of questions from the press pool. How are you cutting if your inflation projections are moving higher? Now, Powell, in his answers, he was tap dancing. And to be honest with you, somebody on my Patreon Zoom call yesterday made this reference. He said Powell deserves an Emmy for his performance because he did project a lot of calm, and Powell's got an amazing poker face, but you could see it. He's stuck here. He's trapped. So what did he made repeated references to striking a balance between the Fed's two goals of maximum employment and 2% or price stability, 2% inflation. Right? He repeatedly referred to striking a balance. And that is, this Phillips curve reference where you can't fight inflation without hurting employment, and you can't help employment without raising inflation. And that this is the academics at the Federal Reserve. They all live by this mantra. So he repeated references to this. Now, he made also several references to the fact that the labor market is now softer than it was in 2019 and pre-pandemic. That's important, right? The job market, we're back to before the vid. That's a big deal. But he also said that job creation has slowed so much now. Again, welcome back to journalism, all the people who are out now actually scrutinizing jobs reports like you should have been doing for the last several years. Job creation has now slowed so much, and it's actually resulting in a gradual rise in unemployment. And by the way, if there is a crackdown on immigration policy, which I think a lot of people are expecting in the months ahead, that is also going to affect the unemployment situation. Less labor supply coming into the country. Now, he mentioned that wages were not really not a source of inflation. He did say that several times. He says wages aren't a source of inflation anymore. But he also said that this gradual rise in unemployment, when we're already softer than we were in 2019, that is unwelcome increases in unemployment. He made several references to that it was unwelcome. He doesn't want to see any more softening in the labor market, which should come as a relief to people. The Federal Reserve is no longer trying to put you out of a job. Gee, thanks, Jay. So Powell's showing a lot of concern about jobs here. On top of that, he's made references to these last few inflation prints, which show inflation, in particular core inflation, is heading in the wrong direction. And again, gee, how are you cutting rates if inflation is heading in the wrong direction? Well, that's what they're doing. So he said it's still broadly in track, that, we've made substantial progress, but he is worried about these last few inflation prints. And he even said at one point, we need to be very careful about not just throwing out the data points that we don't like. And it was actually kind of refreshing to hear Powell say that. But at the same time, he wasn't lending too much credibility to these last few inflation prints. He's noticed them and he's worried about them, but he is expecting them to resume lower. Although, again, if you go by the summary of economic projections, the Fed governors on average all raised their year-end inflation projections for next year. Also, there were some questions about tariffs. Powell didn't sound too worried about tariffs. I think the press pool was kind of fishing for some anti-Trumpisms that they could go print. Jerome Powell worried about Trump's tariffs. I heard a lot they used the phrase look through the tariffs, and Powell referred to 2018, the last time we had tariffs. Tariffs are inflationary, and we saw that in 2018. It did lead to some higher prices, but it was a one-off. All right, tariffs, you get one step change higher in prices, but it doesn't lead to substantial moves in prices after that. And they made reference to some research that they had done on the 2018 tariffs. So they are expecting a bump in inflation if these tariffs get implemented. But Powell, he kept saying, look through. We don't want to discount it, but we don't think it's going to trigger any kind of like systemic rise there. So, the big takeaway there, in my opinion, this hawkish cut, again, jumbo shrimp, that's something of an oxymoron because a cut is a dovish move. But with all the hawkish changes to the S&P, the market freaked out. And I do mean freaked out yesterday. The Dow dropped 1,123 points, minus 2.58% in a single day. That is the 10th straight day of losses for the Dow, the first time since the 1970s that has happened. Wow. Now, futures are a little higher this morning. We're getting a little bit of a bounce. Hopefully that sticks. The S&P down 178 points yesterday, negative 2.95%. The NASDAQ down 716 points, more than 3.5% decline in the NASDAQ. Stocks got beat over the head yesterday with a big Louisville slugger signed and autographed by Jerome Powell. But it wasn't just stocks heading lower. The DXY, the U.S. dollar, significantly strengthened yesterday. 108.26 was the high for the dollar. We started the day below 107, more than 100 basis point move in the dollar. And we're going to show you a couple of stories going on elsewhere in the world. That is reverberating across the globe. We also saw the 10-year yield rising 13 basis points. All right, that's people selling bonds. A big move in the 10-year yield. The Fed cuts rates, and yet interest rates move higher. That's because the Fed cuts the short term of the interest rates, and when people are expecting higher inflation in the future, they start to demand higher interest for their loans, and so the long end of the yield curve starts to move higher on that. We also had a big sell-off in precious metals. So, I was talking with Mish about this morning. What we saw yesterday was not a flight to safety, because when you have a flight to safety, you do see widespread selling in stocks, but you typically see interest rates start to fall on the long end. People move out on the yield curve for safety. They buy bonds, bringing the yields lower. We didn't have that. And in a flight to safety, you usually get buying of things like gold and silver. We didn't see that. We saw widespread selling everywhere yesterday. It was a flight to the dollar. That is what happened yesterday. Sell everything, buy bucks. That was the market reaction. And the VIX, to the icing on the cake, the VIX spiked almost 80% yesterday. It was a bloodbath, no matter how you look at it, guys. That was the most violent reaction to a Federal Reserve press conference that I've seen since I started this channel. And I had a lot of people sending me message, hey, Dow's down $1,000, Jack. Where's my spontaneous live stream? It happened right in the middle of my Patreon Zoom call is when that hit. And so I couldn't go live while I was doing the Zoom, right away. And then by the time the Zoom was over and I had done everything I had to do, it was already late in the day. And if I had done a spontaneous live stream late yesterday, I would have just duplicated the content with this morning's live stream anyway. So I decided against my spontaneous down 1,000-point live stream. Look, also going on today, guys, we got some other central bank action. The Bank of England left rates unchanged. It was a split decision, 6-3. You had 3 of their governors wanted to cut rates, but the other 6 did not. BOE Governor Andrew Bailey expressed some concern about the economy in the UK. These comments are being interpreted as dovish. So that's the move going on at the BOE. The Bank of Japan also announced no rate hike. They are taking their sweet time over at the BOE. The BOE Governor Ueda says he wants to see more data, more awful data, because the data in Japan has been just dreadful for years now. And he's also saying he needs to see Trump's policies before he makes a decision. No, Kazuo Ueda, you're not Trump goggling away your ridiculous experiment in modern monetary theory. It's not Trump's policies that's preventing you from hiking. You are terrified of a repeat of what happened in August. And after you saw that big drop in the Dow yesterday, you are afraid to raise interest rates. It doesn't have anything to do with Mr. Orange. Nice try. Go directly to jail. Do not collect $200. What else we got? Oh, by the way, the yen is collapsing on that news today. Even the Korean pension system, my moderator Mish found a great article on this, and this kind of shows you like the ripples moving across the economy, the global economy from what happened yesterday. The Korean pension system has triggered an automatic clause where they need to sell $50 billion of their Forex reserves because the Korean won, after the big spike in the dollar yesterday, the Korean won has now hit such a low that they triggered these automatic provisions that they have to go sell their Forex reserves to offset the losses from their own currency collapsing. So, I haven't been this impressed by how worthless the Korean won is since the first time I saw an episode of Squid Game, and the guy's like buying a cup of coffee and they're like, that'll be 500 million won. Wow, the won really sucks. Getting worse here. Anyway, that number was Arbor. I just grabbed that number out of thin air. But yeah, the Korean won, talk about rampant inflation. Yikes. We do have some good news this morning. Darden Restaurants just raised their outlook for the year. A little, very skinny silver lining to this big gray cloud here this morning, guys. They raised their outlook. Their comps were positive 2.4%. Looks like Olive Garden and Longhorn Steakhouse are actually doing okay here, seeing positive numbers. Now, Darden has posted some pretty dreadful numbers earlier this year, so it looks like a little bit of bounce back. People may be returning to restaurants now. Signs of life, that's good. The positive 2.4% comps, I would just point out, guys, that food away from home in the last CPI reading was 3.6% year over year. So adjusted for inflation, those comps are still negative, but at the very least, nominally, they're positive again. And there's another big story coming out of Denmark this morning. The collapse of a solar firm called Better Energy is causing widespread losses among banks and pensions overseas. Guys, all these governments are falling apart in France and in Germany. It's all over disagreements over spending and debt, especially as Europe rebuilds its military because World War III. And so all of these things that Europe has just thrown money at, namely the energy transition and all the silly subsidies for wind and solar that they've done on that continent in the last few years, it's going to start going away. And these firms that can't even make a profit when the government is subsidizing the hell out of them, what do you think is going to happen to them now that budgets are getting tight over there? It's probably a preview of things to come, and it's causing problems in the financial system already. We got a lot to talk about this morning. How's about we shrink my big million of a head, and let's see what's going on in markets. Don't forget that like button, guys, and if you're new here, hit that subscribe button because we do this every morning. So come and have your coffee with the melon heads as we go through markets. Look, right now, things are looking pretty good. If you only look at 5-minute candles going back a few hours, the S&P is up 42 points, 0.75% higher this morning. It's a great day for stocks, right? Well, no, this is a dead cat bounce, guys. Let's put this in perspective, shall we? Let's look at daily candles here, going back to about the middle or the beginning of the year. Look at what happened yesterday in the S&P 500, all right? That's, I think, what do you call that? The inverted middle finger from Jerome Powell? I don't know what you call that chart pattern, but that was an ugly, ugly candle yesterday with the S&P dropping almost 3%. So that kind of puts in context the 43-point gain we got this morning versus the 178-point loss we had yesterday. Same story in the Dow, higher by 319 points, 0.75% higher. It's a great morning for the Dow until you zoom out on the chart and you look at what happened yesterday. Look at this move in the Dow, guys. I mean, these are daily candles here. I don't know what's going on here. I mean, we talked about this yesterday. The United Health was a big contributor there, but geez, look at the ugliness in the Dow chart here. 10 consecutive negative days for the Dow. We finally got a little bit of green down here. Look at that adorable little green candle. So nice to see you after 10 straight days of red. Dow, though, still way up for the year. Let's put this in perspective, guys, right? The Dow, yeah, it fell 1,000 points yesterday, 1,100 points, but the Dow is also still above 42,000. So let's just say if this is the start of a big correction or something, there's a long way to go. NASDAQ, meanwhile, up 160 points here. Again, 0.75%. You kind of got this uniform dead cat bounce going on in markets here this morning. Pretty good morning for the NASDAQ, but again, that follows a bludgeoning yesterday. The NASDAQ was by far the worst of it yesterday, 716 points lower, 3.5% down. Down to levels we have not seen since last Monday. And that's why, let's not take this sell-off too far. Yeah, it was a big move. The magnitude of the move was a lot. But let's not forget the NASDAQ has been, in absence or in lieu of catastrophic news, the NASDAQ goes higher every day, all day for the last 4 years, right? Or the last 2.5 years, we'll say. So, yeah, this was a big red candle yesterday. But again, it took us back in time a week and a half. All right. So in context, it's really not that bad. Dixie made a big move yesterday. It's unchanged right now at 108.04, but a massive move in the dollar yesterday, a big strengthening in the dollar. And again, we talked about this in the opening monologue. It was not a flight to safety yesterday. It was a flight to the dollar. It was, man, Brent Johnson must have been just on cloud nine yesterday, the dollar milkshake guy. He was probably strutting down the street with his collar flipped up, kind of like, I'm talking John Travolta, the opening credits of Saturday Night Fever, just kind of looking around, like just flying on air, man. Because the dollar was ripping yesterday. There was panic in markets and everybody ran to the dollar. It was dollar milkshake happening there. 108.07. Again, big green candle here. The dollar is now strengthening pretty substantially here. Look at the move in the dollar since the beginning of September here. Quite a substantial move. We were down as low as 100. We were threatening to go into the 90s there. But now we're actually threatening to go 110. Not quite the highest we've seen all year. Yes, actually, I'm sorry. It is the highest we've seen all year. The dollar is now at the highest we've seen since November of 2022. So significant strengthening in the Dixie here. Looking over at the bond market, we got a mixed bag this morning. The 30-year, 4.736. That's down about 7.5 points. The 10-year that's up 7.5 points. The long end is still moving higher this morning. The 10-year, 4.558. That's up another 6 basis points, and that's after moving up 13 basis points yesterday. So in 2 days, almost 20 basis points of increases in the long end of the yield curve versus a 25 basis point cut on the short end. Goes to show you the Fed does not control what happens out on the 10, 20, and the 30-year. Now, the 2 years at 4.316. That's down 3.8 points yesterday. We had a big move up in the 2-year yesterday as well. And the 1 month is at 4.309. That's down 1.5 points. Looking over at the 10-year yield, again, guys, big move higher yesterday. Let's zoom in a little bit here so you can see it. There's your big green candle from yesterday. We moved up. What was it again? It was 13 points higher yesterday. Moving higher again here. And I just want to point out, again, that whole point about how the Fed doesn't control the short or doesn't control the long end of the yield curve. Here is where the Fed started cutting. All right, when the Fed started cutting rates, and then here is what interest rates have done since the Fed started cutting. See how the Fed does not control this? This is driven mainly by dollar liquidity and by expectations of future inflation. And since the Fed started cutting, those expectations of future inflation have been rising. Looking over at the commodities board, it was a bad day for metals yesterday. Gold is getting a little bit of a bounce here, though. $2,596 for spot gold. Back under $2,600 an ounce. It was a really bad day for spot yesterday, but we're up 10.5 bucks here, 0.4% higher. Silver, oh man, I had to open my mouth about silver. the inverse Jack indicator when it comes to precious metals, back below $30, $29.17 for spot silver. We're down another 18 cents, lost almost $1 yesterday, 2/3 of 1% lower for silver. We've got copper's lower by 1.25% this morning. Platinum's down 1/3%. Palladium's down 3%. Big move lower in palladium here. And WTI crude oil, $70.52. That's down by about a nickel this morning, or 0.09% lower. And look at this move in the VIX. Just to wrap up, guys, big middle finger there from the VIX yesterday. Big spike in volatility. One of the biggest spikes we've seen. If you take away August, that August 2nd Godzilla sell-off because of the yen carry trade, I believe this was the biggest move in the VIX since Volmageddon in 2018. So big move up there. It's come back down, still elevated in the 20s. Tough day for the VIX. Also, Bitcoin, big sell-off yesterday, down from its highs of around 108,000 and change. Yesterday, Bitcoin dropped a few $1,000. Overnight, we hit a low of 98,698. Looks like we're getting a little bit of a bounce now, back above 102,000 here. So Bitcoin also getting this dead cat bounce. Guys, pretty much everything right now is reversing yesterday's move. I don't know, is this a dead cat move bounce and we're going to resume lower, or is this just like the dip buyers came in and absorbed all of that Powell-induced selling onward and upward to new highs? Only time's going to tell. But get used to some volatility here. That's all. All right, we're going to skip over. We did a lot of Fed talk, so we're going to skip over that. Let's talk about what's going on in the BOE here. BOE keeps rates unchanged, even as 3 officials back cut. All right, so now we're talking central banks across the pond. It was a 6-3 vote to leave interest rates at 4.75%. The Bank of England signaled it will keep easing gradually as more officials back calls for an immediate cut in borrowing costs, prompting traders to boost bets on reductions next year. The Monetary Policy Committee voted 6-3 in favor of keeping its benchmark interest rate unchanged at 4.75%, according to minutes from this month's meeting released on Thursday. We think a gradual approach to future interest rate cuts remains right, Governor Andrew Bailey said in a statement. But with heightened uncertainty in the economy, we can't commit to when or by how much we will cut rates in the coming year. Investors took the vote split and Bailey's comments as surprisingly dovish, adding to bets for reductions in 2025. Money market pricing implied 2 quarter-point cuts and a strong chance of a third. Gilt yields dropped relative to where they were before the decision, while the pound trimmed earlier gains to trade around 1.26 or $1.26 per pound. So we got a dovish move from the Bank of England, or a dovish non-move, a dovish non-cut from the BOE, a hawkish cut from the Fed. You following me here? These animal things are getting hard to follow. And then we've got the Bank of Japan. BOJ's Ueda hints at a chance of a later rate hike, sending the yen lower. Once again, the BOJ has done nothing. They are just analysis paralysis over at the Bank of Japan. They have got the most dovish monetary policy in the history of the freaking earth over in Japan, and they are still refusing to move after just 2 tiny little rate hikes all year long. Bank of Japan Governor Kazuo Ueda opened up the possibility of waiting longer for his next interest rate hike in comments that lowered expectations of a January move and hammered the yen. Ueda said more information on Japan's wages and the policies of U.S. President-elect Donald Trump is needed before the BOJ can decide on a rate hike. What the hell does Donald Trump have to do with money printing in Japan, you might ask? The answer, of course, is nothing. His comments made at a briefing after the central bank stood pat on rates extended the yen's losses against the dollar, with the currency breaching the 157 mark, the lowest level since July. Ueda said the overall picture on wages should be clearer by March or April, and it may take time to assess the full impact of Trump's policies. Or maybe they're talking about tariffs here, but to my knowledge, Trump hasn't talked about tariffs on Japan. He's talked about tariffs on Mexico, on Canada, on China. Are Japanese tariffs even on the table? I don't know. But it seems like he's Trump goggling his modern monetary theory over there. That was a little, seemed a little off to me. Didn't quite pass the sniff test this morning. He also indicated that he doesn't have to wait until all the information is available. Look, I don't know what they're waiting for at the Bank of Japan. I honestly don't. They're taking their sweet-ass time, but I don't know what they're waiting for. Look at what happened to the yen yesterday. Again, that strengthening dollar, sending reverberations across the global economy. Big green shoots in the yen yesterday, significant weakening. Remember, this is USD JPY. This chart moving higher means it takes more yen to make $1, which means it's a weaker yen. And the yen is now weaker than it's been since that initial strengthening, right? Remember all that strengthening we saw in July and August? And then the yen carry trade, and Michael Gayed was saying, I told you so, all over the place because the yen carry trade was unwinding. We had that August 2nd bloodbath in stocks. Well, the yen is like pretty much right back to where we started before all that happened here. I mean, the yen hit an all-time low of 161 at one point, almost 162. So we haven't quite gotten to that level where the BOJ would be forced to intervene. But considering that the BOJ just did nothing, they said we're going to wait till January, maybe even March before we do another rate hike. You're going to keep seeing the yen weaken. So we're going to be back to these levels in no time here, which means we get to relive that whole ridiculous episode of the unwinding of the yen carry trade again. Because right now it looks like the market is putting the yen carry trade back on. Remember that press conference we saw 2 days ago with Masa-san from SoftBank posing with Donald Trump saying, I'm going to invest $100 billion in United States infrastructure and data centers and round tripping. Where do you think he's getting that $100 billion? He's going to borrow yen, flip them to dollars, and spend them in the United States. It's going to be one big yen carry trade. And so as the yen is weakening, they're just putting more of those on. Well, you can expect that to unwind again at some point. Like we'll be right back to where we were in August at some point soon here. Another reverberation across the global economy. The Korean won hits a trigger for up to $50 billion in pension sales. What Jerome Powell did yesterday is now affecting retirement accounts in South Korea. It just goes to show you how a strong dollar can really cause problems here. Again, paging Brent Johnson. Korea's won has weakened to levels that can force the National Pension Service to sell to up to almost $50 billion worth of foreign exchange to hedge against losses, according to people familiar with the matter. If the average closing exchange rate exceeds about 1,450 won to the dollar for 5 business days, the National Pension Service will implement strategic hedging, the people said. Once activated, strategic currency hedging will continue unless the exchange rate drops significantly. The pension service is obligated to hedge up to 10% of its foreign currency assets if the exchange rate reaches a level that deviates significantly from its long-term average over more than 20 years. The people told Bloomberg, asking not to be named because nobody wants to name themselves in the press. As of Wednesday's drop to the lowest since 2009, the 1,450 won per dollar level had breached the National Pension Service's own internal trigger, according to a formula that people shared with Bloomberg. The lowest since 2009. Anybody remember 2009? Was that a good year or a bad year? I don't think 2009 was really a year most people would care to repeat. Last one. We're going to talk pretty quick about this, guys. Darden shares jump as outlook signals diners are returning. All right, big move higher in Darden restaurants. They own Olive Garden. They own Longhorn Steakhouse. We're getting a little long on time here, so let's just get down to it. They now expect their physical sales of $12.1 billion for 2025. That is above average analyst estimates of $11.9 billion. So they're raising their outlook for the year. Second quarter revenue was $2.89 billion, in line with estimates. Comparable sales of positive 2.4% year over year. That's a big change for Darden. They've had really lousy comps for about a year now, finally moving back into positive territory, at least nominally. Again, that's still below the rate of inflation for food away from home in the CPI, which came in at 3.6%. So still overall less sales, but at least that dollar value number is moving north again. Demand is expected to return next year after persistent inflation and weak consumer spending hurt the casual dining industry. Darden rolled out a delivery partnership with Uber Technologies last quarter. It also ran the never-ending Pasta Bowl promotion at Olive Garden from mid-August to mid-November, 4 more weeks than last year. So some signs of life in the economy there. Some good things happening at restaurants. Darden restaurants up 8.2% ahead of the opening bell here, trading at $173. Pretty good day for that stock. And last but not least, solar firm collapse reverberates through the Danish financial system. All those silly renewable energy stocks that are 100% dependent on government subsidies, guys, they are in big trouble here. And the banks that loaned money to them, more importantly, they're in trouble here. The collapse of Denmark's Better Energy, a once hyped solar park developer, is sending repercussions through the Nordic country's financial system and bringing eerie reminders of the recent problems for another green energy champion, Northvolt. in neighboring Sweden. Better Energy on Thursday said it will start a reconstruction process of two of its main units, blaming poor market conditions and an unwillingness from its investors to provide more funding. It's almost like liquidity is getting difficult to find here. Among those burnt are Sydbank, Denmark's third biggest lender, which cut its 2024 financial outlook on Thursday and said Better Energy's collapse could lead to 450 million kroner of losses. That's about $63 million. Denmark's biggest pension fund, which owns 15% of Better Energy, also among the owners of Northvolt, will lose a three-digit million kroner amount. That's, again, three-digit millions is about tens of millions of dollars U.S. Northvolt, the other company that they're referencing here, they're a maker of electric vehicle batteries. Last month, they filed for bankruptcy protection in the United States after failing to make enough cells at a sufficiently good quality. The collapse came as a shock after the Swedish company had been touted as a European champion to rival China's rising dominance in green technology. Like Northvolt, Better Energy expanded at a fast pace, backed by the institutions eager to invest in the green transition. Oh, there's those ESG investments coming back to haunt us. Who could have seen that coming? Since 2020, the Danish company has been behind about half of all newly commissioned land-based renewable energy projects in Denmark, it says. Better Energy said its problems are caused by a toxic cocktail of volatile energy prices, higher interest rates, supply chain issues, and higher input costs, not to mention a lousy business model. The company said it hopes the reconstruction process will enable it to continue its operations in 2025, when it will attempt to raise enough working capital to exit the reconstruction. And I'll be honest with you, I don't really know what exit the reconstruction means. I can tell you guys, if your business is dependent on subsidies from a European government, you better be you better be finding Jesus in your business career here, thinking about, reviewing your outlook on life, because things are not looking good. European governments are toppling because of spending disagreements right now. Not looking so good over there. Armando Reyes, thank you, sir, for supporting the channel. He says it's time for the next 100-year depression. Oh, I hope not. I didn't live through the last one, but I don't hear good things about the 1920s and 1930s, by the way. Late 20s, early 30s. I'd suggest that everyone start stretching and get on your marks in case of bank runs. Everybody, rule number one, limber up, right? No, rule number one was cardio. Limber up was one of the other rules. Let's see, stretching, get on your marks in case of bank runs. I think we're still probably a long ways away from bank runs here, guys. We dodged that bullet mid last year, largely because the Fed decided to start printing money again. And here we are a year and a half later, and inflation is rising. I'm beginning to think these two things might be related. The money supply has been growing since the end of last year, and now here we are, and inflation is on the rise again, guys. These two things are not a coincidence. All right, as long as they keep expanding the money supply, we're going to see inflation moving higher. And right now, the biggest problem in the employment market, in the jobs market, is inflation. So throw out your Phillips curve. The higher inflation goes, the less money people will have to spend on discretionary items. The more people will lose their jobs in those discretionary industries, the higher unemployment goes. All right. All these people at the Federal Reserve, all these academics with their PhDs, they have all been trained on the wrong thing. This ironclad inverse correlation between inflation and unemployment. It works most of the time, but not always. And they refuse to admit that despite the 1970s. It's time to throw out that Phillips curve. Thank you, Armando, for supporting the channel, sir. And thank you to M&J, my blue wrench. Thank you so much, M&J. She says, Melon's big views this morning. Could we get 75 of you to hit that subscribe button? Help us break that 60,000 subscriber mark, please. Yes, the 60K barrier. All I want for Christmas is my 60,000 subscribers. Come on. I think we need about another 70, guys. Maybe we get there today. I don't know. Stranger things have happened. Thank you so much, M&J, for supporting the channel. Also, thank you so much for everything you do to keep things neat and tidy in the chat. M&J, Nan, Mish, all my other mods, guys, thank you so much for what you guys do. I really do appreciate that. You're awesome. And Break My Wallet Motorsport, man, I love that name. Every time I read it, it cracks me up. He says, 321 cracks bed, LOL, down to the low 15s. All right, I don't speak fuel refinery lingo all that well, but I believe we're referring to refining fuel here in the 321 spreads. I'll be honest with you, some of that's flying over my head, but I'm guessing it's got something to do with diesel consumption in China possibly being a problem. I've been reading a lot about how China has made this very rapid transition from their trucking industry being mostly diesel driven to now being powered by LNG. And it's been such a rapid transition that it's actually starting to impact global diesel consumption statistics. And I believe it's affecting these statistics that you're referring to here, the crack spreads. But I don't know that much about crack spreads to really comment on that effectively here. So further research required for me on this one, Break My Wallet. Thank you so much, though, for supporting the channel. I appreciate that very much. And Armando is back again. What's up, Armando? He says, if it gets any worse, you can say bye-bye to your 401ks. Maybe even the government might stop sending out tax returns. Just kidding. Helicopter money go. Yeah, you're right. The tax returns, I wouldn't worry about that. Possible the government shutdown / debt ceiling. Maybe that does impact the mailing of tax returns next year. That is entirely plausible. We're not there yet. That spending bill in Congress is falling apart in real time, guys. They snuck so much BS into that spending package. Like, what the heck does the Washington Commanders Stadium have to do with funding the government through the end of the year? Like, these idiots in Congress can't help themselves. And now it looks like this bill is going to fall apart. And who's going to suffer for it? Well, first of all of our ears, because we have to sit through ridiculous political posturing speeches again. But on top of that, the farmers are going to suffer because that farm bill isn't going to get passed. And the people in the Southeast, their suffering will be prolonged unnecessarily because the aid package from the hurricane still is stalled out in Congress. Why are we attaching relief for our own people from a storm to all this petty BS that they want in Congress? It's inexcusable. And guys, I'm not going to point at left and say your fault. Both of you do it. All right. Republicans, Democrats, you both suck. Let's be honest. You both snuck BS into this 1,500-page bill, including a 40% raise for yourselves. And unfortunately, the people who were hit by the hurricanes are going to suffer for it. Shame on Congress. Shame on our elected officials. Shame across the board. And yes, helicopter money, Armando. It is coming. Abso-freaking-lutely. Oh, it's a crazy world we live in, isn't it? Harmon Air LLC, thank you, sir. He says ISO 2022 payments go live the 10th of 2025. Is that new XRP-based payment system that they're rolling out in the Middle East, I believe, that the XRP army is all about? I believe that's what that is, that ISO 222, or what's that number, 20,022? I'm hearing Japan had invested interest matching that March, April timeframe you mentioned. All right, I'll be honest with you. I haven't followed this story all that close either, but let me just comment. If this is the XRP payment system that I keep hearing about, I got to tell you guys, I am just not in that XRP army. Sorry, I'm sure I'm going to get brigaded in the comments because those XRP guys, they keep it tight and they speak in unison. Look, I have watched XRP consistently fail to even take out its prior highs from 2017, 2018. It's just hard to get excited about that one when I've seen all these other coins massively outperform that. And even all those other coins, I'm not even into them, guys. I go Bitcoin and I don't go anything else. And, look, if you're making money on Fartcoin, congratulations. Remember to take profits because that rug is going to pull. I'll have more to say to that on the days ahead. Just be careful, guys. Be careful. We're in that FOMO rally in crypto phase, last 24 hours notwithstanding. The frauds are on the rise again. Be careful. There will be another FTX. It's only a matter of time. Thanks again, Harmon Air, for supporting the channel. And thank you, Metals Banker, who says, don't forget Congress salary rises up to $240,000, $243,000. Those poor congressmen, somebody's got to pay for Nancy Pelosi's big pull-out cabinet full of ice cream. Remember that video during COVID when she had like her 50,000 flavors of Haagen-Dazs? Oh, she's so relatable. Well, the price of ice cream has gone up. Congress needs a little something. They're working hard for the American people. They get up every day and they're tired and their back hurts from working in Congress. And they're like, the bills are piling up and the kids are screaming and the baby needs braces or something like that. How is a congressman supposed to make ends meet? And hopefully by now you figured out that I'm laying on the sarcasm a little extra thick this morning. It is absolutely obscene that people who have a lower approval rating than freaking Al-Qaeda have voted themselves a raise in a spending bill that is holding hurricane victims hostage. You're absolutely right to call that out, Metals Banker. That is obscene. I don't care if Congress hasn't had a raise since 2011. Let's be honest. We've all seen Nancy Pelosi's stock tracker. Congress is making money. They're getting paid one way or another. We don't need to pay them anymore, not another penny. Thank you very much, Metals Banker, for supporting the channel. And thank you, everybody, for having your coffee with the Melonheads this morning. Just a reminder, hit that like button on the way out and subscribe if you're new here so we can do this again tomorrow. That would be swell. Thank you, everybody, for the super chats and the generosity supporting the channel. Also, thank you to my magnanimous Melonheads on Patreon and YouTube for supporting the channel. Links down below, should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.